Good morning, everyone. I'm Caroline Hanratty. I'm a real estate partner at Mills & Reeve. Welcome to the third of our 2022 discussions on patient capital. The previous two sessions and all of last year's are still available on our website if you'd like to take a look at those. A little bit of admin to start with. You've had the QR codes, which you'll get back at the end if you'd like to connect with us on LinkedIn. And there is a Q&A function if you have any questions you'd like to direct to our panel. I'll try to keep an eye on that and we'll try to get to some of them. If we don't get to all of them, we'll try to follow up afterwards. So now to the interesting bit. I'd like to introduce you to our panel this morning. Nigel Hugill is Chief Executive of Urban&Civic, the UK's leading master developer, currently with 14 strategic sites. As master developer, I got that wrong? No?
No, that's right.
Good. That's good.
That's all in delivery.
As master developer, Urban&Civic take responsibility for getting an outline planning permission for large blocks of unconsented raw land, then delivering the infrastructure to enable them to offer oven-ready, fully serviced parcels of land to house builders. Andrew Bickerdike is a planning director at National Planning and Development Consultancy Turley. He specialises in residential development, including urban living, strategic land promotion, and residential-led regeneration projects. And Charles Staveley. Charles Staveley is one of my Mills & Reeve partners and leads our real estate investment sector. His clients include institutional pension funds, onshore and offshore investors, and local authority investment funds. So, Nigel, if I could start with you, please. When you spoke to us in February last year, you predicted that others would seek to replicate the Urban&Civic model, but you also commented on how it was taking far too long for you to get the large outline planning consents that you need for your business and for your model. So, are there any signs of any new master developers and any improvements in the planning process?
Morning. Commentaries like these it's a bit like financial investment. It's always easier to make in hindsight. So the short answer to your question as to whether there's greater institutional interest is probably no. Last year, to remind listeners, was just after Urban&Civic had been acquired by Wellcome Trust. And the reasonable presumption from there was that that would trigger a further set of interest from investors in strategic land. In fact, what we've seen, and it goes to the second part of your question, is that rather than getting easier, other than perhaps permitted development rights, pretty much everything else has got more difficult. And so they've been using the terminology of financial investors. There have been two parallel headwinds. There's been for the entirety of the planning industry, there's been the continued frustrations of processing resolutions to grant to detailed consents. So we have a very able land promotion business called Catesby, which has suffered along with everybody else from that processing. The results of COVID revised working practices, relatively low morale within the planning industry, and just the continued toffee of all, and also actually the politicization where planning officers are being blamed by members. So you've got that on the one side, and then on the other hand, you have, in relation to strategic land, there have been some big elements which you can chart on that. So the first, you might be surprised, is in relation to the census. If we get time, we should talk a bit about the census. That was in March. Those figures are likely to come in low. We then had in June the by-election result in Chesham and Amersham, where a 25% swing to the Liberal Democrats caused really substantial ructions within the southeast of the parliamentary Conservative Party. And then in September, we had Robert Jenrick losing his ministerial seat as part of the reshuffle, which was literally just days before the planning bill was going to be announced. So all those, each one of those was a kind of ratchet to make things more complicated. And then to top it all, we've had this year, Natural England flexing its muscles with, or expressing its frustrations with water and nutrient neutrality, which has brought another overlay across quite a substantial part of southeast England, where with a series of Delphic statements, you know, they could have blamed cows, they could have blamed water companies, but they chose to blame the housing industry. So that again is another uncertainty. And so just to finish off, in relation to that institutional investment, if I look at the example of Legal & General, so they bought a big site at North Horsham in 2019. They were just limbering up. It had taken them 3 years to get through into the detailed consents. They transferred it over to Carla, and then they got whacked with this question of neutrality, so which will slow things down further. So if you're an institutional investor, that's not a great, unlike last year when we had Welcome coming in and having acquired Urban&Civic, that backcloth is not a particularly propitious one.
No. Okay. Andrew, I was at a conference last week and I heard somebody say that the planning system was broken. Is the planning system broken, and how's that impacting on investment?
Yeah, I mean, there's a lot to unpack there, and Nigel has set the scene very effectively, honing on some critical issues that he faces in the context of his business. I think the planning system operates in two ways. There's the local plan process, which is development of forward-looking plans that are intended to look over a 15+ year period. And then there's the processing of planning applications. Both are, as Nigel says, highly politicized, increasingly so. I think Nigel's touched on an interesting point in terms of goalposts continually changing. Local plans take a number of years to put into place. And it's very rare that there aren't strategic changes within that window that affect the ability of councils to move forward and develop their local plans based on sort of certainty, whether that be the political climate, whether that be, you know, who's in control of the council, or whether that be in terms of household projections, which govern the amount of land the councils have to release effectively for housing development. So those goalposts are constantly changing, and they're certainly changing several times in the context of the period that it takes for local authority to develop a local plan. So it's not surprising that the local plan preparation process is drawn out, is laborious, is very sluggish, and it's very stop-start. I mean, so many local authorities start the preparation, get so way along the line, and then something changes and they have to take 2 steps back, and they never actually release a local plan. And that's problematic for the house building industry insofar as if you're in Nigel's sort of area of work, promoting strategic land, typically the only way to get any sort of planning consent is through the local plan process. The government is very clear that it won't support greenbelt planning applications for housing developments. In effect, you can't satisfy the very special circumstances test, which is written into local international policy outside of a local plan process. So if the local plan process grinds to a halt, then the delivery of strategic land grinds to a halt. Added to that, local authorities that have greenbelt in their authorities are fundamentally disincentivized to prepare local plans, because until a time when the house building industry and the strat land promoters can secure planning permission on greenbelt land outside of a local plan, then there is a lack of incentive for those local authorities to forward plan to release greenbelt land, because the greenbelt land is effectively protected until a local plan is put in place. So there's a fundamental disincentive for local authorities to move local plans forward. And we see that there's some quite high profile cases in the north, in York, particularly on the Wirral, where really they just haven't had a local plan in place for decades. On account of the fact that it would involve them having to make difficult decisions that they don't otherwise have to make. Resourcing, massive problem, as Nigel's pointed out. I think the politicisation really is of the planning system is key. We get local authority officers who don't see it as their remit and brief to take a view on things. They are very much guided and influenced by the politics and forced into making decisions which goes against their professional judgment. I think the other last thing I would point out is the number of stakeholders involved. The planning system operates on the basis that the government's kind of specialist advisors in areas around ecology or flood risk or highways reach a consensus around development. And only when that consensus is reached can the local authorities move forward to take land out of the green belt or any other designation that needs to happen for land to be released for housing development. So in the case of the Environment Agency on Natural England, they effectively can hold the process to ransom. They have the tools, they have the legal mechanisms to stop development happening. Now, all they care about is their brief, is their one area of specialism. They're not particularly concerned about the bigger picture issue of the need to deliver housing growth in a sustainable manner. Natural England are concerned with things relating to the natural environment, understandably, but they have the legal framework behind them that can effectively stop development happening and progressing and stop local plans moving forward positively. So the idea that Natural England, the Environment Agency, National Highways, any other advisory body of that nature all have to agree on something in order for a local plan or a development to move forward, it's incredibly challenging to get to that point. It puts the planner right in the middle of that process, but the planner in that context is really just a sort of administrative role. They don't have the authority to take a view, to apply their professional judgment and to manage those advisors. And they are just advisors to the process in order to identify what are the most sustainable solutions to meeting housing needs.
Okay.
Put all that together, incredibly challenging environment.
Okay.
And just quickly, of course, that was the planning bill was intended to straighten up some of those elements. And so the taking away of that has meant that quite a number of those strictures are, if have anything, been strengthened.
Yeah.
So yeah, so many different factors. Charles, so many different uncertainties, not so appealing from an investment point of view. And then at the moment, at the current situation, perhaps getting on something slightly different, at the moment, it seems you can't turn on the radio without hearing the word inflation. How is that? Which asset classes are being most affected by the current inflationary pressures, do you think? And what are the other challenges for those long-term investment funds, maybe over the coming 12 months?
It's a big question.
Yeah.
I think we just heard sort of the planning challenge, which is relevant to any forward funding sort of position that, again, we've seen a lot of the long income investors like to take. Inflation certainly is already putting pressure on pricing. So interest rates moving. The types of asset classes I think that have been most affected are those that are reliant upon either consumer behaviour or have those inherent costs within them. So you could point to luxury retail, so luxury hotels possibly may just find it difficult, but I think it's going to affect every asset class in some way. It's just almost going to be the type of investor that's going to be more impacted. So if you acquire with the use of debt, so private equity investors typically, those sort of asset class, also investor class users, then they're going to struggle because they're going to be having pricing issues themselves with the money they're putting in. Institutional investors have their own issues. Nigel, Andrew touched on those in a strategic land context, but they are, they've got gilt rates moving out, there's pressure on pricing, and we're already beginning to see some asset pricing softening. So I think that is going to be a continuing shift. What's going to be interesting is what we do. Are deals going to fall over, or are they just going to be renegotiated as we go through the summer?
Okay.
And see, Carolina, you asked me a question in relation, which effectively is in relation to pipeline. To Charles's point, of course, of the 14 schemes that we have, 7 of them are in delivery. And those the interest in those has increased really substantially during the course of the last 12 months. And indeed for Catesby, when we get a consented project, the level of house builder interest in buying that land has never been higher. So you're seeing this real dichotomy between and it's logical in that pipeline is tougher, existing consents in areas of short supply have become correspondingly more sought after. So the value of that for us in relation, so in the short term, actually the value of our business has probably gone up because of the fact that the existing investments have become more valuable. But it's that combination of the two.
And that's despite the increasing construction costs, because
so land prices, and for us as you know, we have this bespoke license model where essentially we participate in the house prices that are realized. So yes, the construction costs have gone up, but that's the bigger deal for the house builders, honestly, than for us at this point.
Yes.
Because ours is mostly civils work, although things like schools have become really substantially more. But you've seen that the construction cost has been reflected in house builder margins, and of course, then if you look at the share prices of the quoted house builders, they've gone down really quite substantially. So the sector is down 35% over about 18 months, which reflects the combination of actually higher land prices and higher construction costs, and therefore lower margins for them.
Yeah. Okay. Andrew, if I could just turn to another asset class, and that's build to rent. The last few years in Northwest, particularly in Manchester, we've seen exponential growth in build to rent. I've heard it cited as being the build to rent capital of the country, or the UK. I think it's the UK, not just the North. Is that growth sustainable?
I mean, the build to rent market, more broadly, looking outside of Manchester, yeah, absolutely it's sustainable as long as the underlying drivers of that demand remain, and they are, in their simplest terms, a strong economic base, which is clearly what underpins, any sort of built development industry, and a constrained supply of housing more generally, to the extent that is continue to push up house prices. So, as long as people struggle to get on the housing ladder, then yes, build to rent will continue to grow. And it's in its infancy in this country, as an asset class. It's only been around for sort of 10, 15 years at most, and it's clearly gained some momentum over perhaps the last 7 or 8 years. I think as a kind of an investment class, what we've got to realise is that if you look at sort of the urban living sector pre-recession, everything was based on building units and selling them immediately, and then the developer investor departs and exits the development effectively. And as a result, the crash and the banks' unwillingness and inability to lend, pulled the rug from underneath the feet of that sector. But with the institutional build-to-rent sector, we have a situation where those investors are taking a long-term view, and short-term economic shocks and inflation might not necessarily undermine that asset class in the way that it undermined the equivalent urban living products pre-recession. Other than to the extent that you only pay for build costs once, and if build costs are at their height, then clearly you don't want to be making that investment at that particular point in time. But the long-term outlook, the fact that the return is planned for over a long period of time, in my view, and thus far in my experience, should underpin the long-term strength of that market. In a Manchester context, as long as the city keeps thriving and being an attractive alternative to London, if that's not too bold a statement for young professionals, then the market here will continue to grow.
Yeah. Okay.
Caroline, can I just say, I think there's always been a challenge in build to rent of creating that net yield position, and obviously you've got inflationary pressures on costs of construction, etc. So that's always going to be a challenge for it. But I think Andrew's absolutely right. If you take the longer term view, and the institutional investors definitely are. Nigel mentioned L&G; they've been very big players in this space in recent years. Then there is definitely a future for this market, but you've got to watch the ability to deliver a competitive yield versus other asset classes.
Yeah.
And the other element at the moment is that there's just a massive amount of money that's been committed to the sector. So there's more money available to make investments at the moment than there are investments. And so we are building to rent on our own developments, and the yields that are coming in on that, notwithstanding Charles's comments, are getting lower. And the reason they're getting lower is because of the weight of money looking to make investments.
Yeah. I was at a build to rent conference recently, and an agent said to me, well, people have run away from retail and they're running away from offices. So where else are they going to go? So I think agents are starting to realise they need to get good at build to rent.
Classic agent comment.
Yeah, I was going to say. I mean, I think they've always categorised it as an alternative asset class. I just challenge that. I think it's the difference between what was mainstream and what was alternatives are very much merged together, and smart investors are now recognising the opportunities they all present.
It doesn't.
And the advantage for us in that process is that if you look as the build to rent market has matured, it started off being multi-let accommodation, large blocks, particularly in London, to some extent in Manchester. There's now that move towards wanting to invest in single family housing, which is a discernible shift in that process.
Yeah. And we see, I mean, we have legal in general with a suburban living, suburban build to rent function in the northwest as well as other parts of the country.
Yeah, there are a whole number of funds looking to invest in single family housing.
Yeah.
There are, yeah. I mean, I suspect there's greater competition because they're competing for sites with the volume house builders. Typically, broadly speaking, they have the same sort of site and locational requirements as the volume house builders of this world, that are very lean machines, very efficient, and have kind of been there and done this a million times. So as a growing area, it's going to be a difficult one to get into at real scale. But the opportunity is absolutely there, and they're certainly making inroads.
Yeah.
And I'm cautious of making further predictions, but it may be that actually you see some of the house builders building to rent, to sell to those funds in circumstances where the yields are coming down, and if there isn't the same level of demand in the private sale market. For house builders, their first preference would always be for private sales, but if you see a really significant reduction in that, which actually I'm not expecting, but if there were that, then you could imagine that house builders would look to replace some of those sales with build to rent, because there really is a lot of money out looking for a home.
Yeah. Okay. And then on the site, so we've got another 5 minutes. So just on a slightly different tack, Nigel, I know Urban&Civic has just released its sustainability framework.
Yeah, well, we can talk about that. If we've only got 5 minutes, I think it's worth having a quick word about the census, because that's probably of interest to listeners. The sustainability framework that we've released is a toolkit, and it's on our website, and I encourage people to look at that. In relation to the census, it could be really potentially quite significant and might well complicate up an even further an already complicated picture. If people will remember, it was taken last March. That was a real low point in our population. Quite a lot of Europeans with settled status have gone home. Some of them now have come back. So it's almost certainly the case that those figures are going to be pretty low. If we look at America, the American figures that have just been announced show population growth for the last year of 0.12%, which is the lowest since they kept records in 1900. And so it could well be the case that we're looking at a low set of figures here. And of course, if that's the case, then that leads directly into potential re-evaluation of the whole 2014-2016 housing projections on which the local plans are all based. So it could well be that within 2 weeks, you're going to see a real, what I call the politicization of statistics. Because on the one hand, those that want to see extra housing will say, well, the statistics are not representative. On the other, those that are opposing development will say, well, these are the only pure statistics that we ever get. They're in 10 years, that the response rate was 97.2%. So that we've got a new potential battleground that could well be emerging in the next couple of weeks. So people should keep an eye out for that.
Okay.
And I would add to that in terms of those that are promoting land, clearly affordability indicators are going to be increasingly important in the context of potentially census results that indicate a slowing down of population growth and therefore household formation. If the affordability indicators are still telling us that key parts of the country, large areas of the country, are fundamentally unaffordable, then that is a direct indicator of a continuing housing need, notwithstanding household formation.
And there's the argument. That's the politicization of the argument.
Yeah.
And that's when we perhaps need a housing minister to last slightly longer this time, might suggest. The last few haven't last. How many have we had in the last few years?
I've got a lot of sympathy for local authorities. Like what my opening piece, hopefully didn't come across as a criticism of them. They've got a very, very difficult job in very difficult circumstances, and yeah, it's tough. Added to that, they're underfunded. So it doesn't make for sort of an easy framework within which to work.
We've had 13 housing ministers during the time that Urban&Civic has been in existence.
Yeah, it's too many. Yeah. So very quickly then, the last couple of minutes, has anybody want to make any predictions for the next year in terms of long-term investment that I can come back and quote you on when we talk again next year? Charles?
To quote me on, I think institutional investment, so equity-based, will still be active. There's still a lot of money there to be placed. The asset classes they're looking at will be interesting, and you're going to push me on that. So I'm going to predict, I think, residentially led, and by that I mean we will talk buy to rent, but I'm wondering also about retirement villages, if they can make them stack up, which I think increasingly they will, and the demand is there. Moving into healthcare and associated uses there, and logistics with a little bit of hesitation, because I think that's been so hot, inevitably pricing has got to move a bit. Anything with strong ESG credentials will be very attractive. We're seeing increasing number of social impact funds coming to market, and I think they're going to have a positive play. There you go, some predictions.
Great, thank you. Andrew, any predictions in a nutshell?
PBSA, purpose-built student accommodation, particularly in North England, it's a big sector for us. It's not necessarily driven by a sort of a market position. It's more of a kind of policy historical policy restraint position in certain cities in the north, which is now releasing and potentially opening up opportunities. Affordable housing as well, sort of first homes and the like. A lot of the funds are moving into that sector, making that work on commercial terms, sometimes underpinned by Homes England funding, sometimes not, but we're getting an increasing number of inquiries in that area.
Okay, great. Nigel, any other predictions, or is it?
No, I think the ESG point is a really strong one. That's part of the reason that we've launched the toolkit is in order to demonstrate the empirical pickup that you can achieve on large sites, which you simply can't do on infill. I think that in relation to the housing market, what we will see is a really considerable drop in transactions. So last year, because of the stamp duty holiday, there was a much higher level than had become the trend. So it was about 1.5 million overall transactions, because the stamp duty holiday was like this giant lubricant that sort of moved things through the system. I think once we see the fall off of that, we might well be down at 600,000 or 700,000, a very much lower level of transactions, and that will then have its own ramifications. But I think the debates that the census will engender will certainly justify another program on your part.
Okay, great. Well, that's good. Okay, well, it's just gone 11, so I'll bring it to a close. Thank you to everyone who's been watching. I hope you've enjoyed the discussion. Please do just take a couple of minutes to complete our feedback form, if you wouldn't mind, which will appear to you shortly. And a huge thank you to Nigel, to Andrew, and to Charles for giving us their time and their insights this morning. Thank you so much. Enjoy the rest of your day, everyone. Thank you.
Thank you.